and welcome back to yet another exciting week of the Lazy Money Game. In this week's episode, I will start by answering some questions from the audience, then I will give an update to my portfolio, and finally I will share my latest purchase as well. So the question that I have received is regarding my strategy. So the viewer wants to know why I'm not focusing more on higher yielding dividend paying companies than the ones that I'm currently investing in. And then the example was something like OKE, for instance. So to try and answer with this specific company in mind, let's go to Seeking Alpha here and take a look at OKE. So the first thing we obviously notice here on the dividend sheet is that they have a high dividend of 6.78% if you were to buy it at the current market price. You can see that they have a really nice dividend growth rate of 8.74% as an average over the last 5 years, and they have 19 consecutive years of increasing that dividend. That really sounds promising. But then when you take a look at the payout ratio, this is where they fail to meet my criteria, since they are paying out more than what they are actually earning, meaning that they cannot sustain this. And I want to invest in companies where I think they can actually sustain the dividend and even increase it. So perhaps this is just because they have had a bad year and they have decided to take on a loan to be able to pay out the ever-growing dividend. But simply due to this fact, then I do not want to buy into a company like this. If we then switch to my portfolio to take a closer look, well, the first thing we immediately notice is that there's a red circle for this week's episode, meaning that the portfolio is down in value compared to last week. If we go to the portfolio values tab here, we can see that the portfolio has decreased by $1,500 compared to last week, and at the same time that the cost has not changed. But the only reason why the cost has not changed is due to the fact that I had a lot of cash. But if you take a look at the cash here, you can now see that they have been quite significantly reduced since I have invested a little less than $10,000 within this week. If we then scroll to the top of the sheet here, just to include all the holdings in the portfolio, you can now see that there is an additional line since I have decided to invest into VICI Properties. I will go into the details of this purchase later in the video, but if we for now just focus on the dividend to begin with, we can see that they pay 36 cents per share, and that means with my purchase that I am going to receive a little more than $475 in annual dividend income, giving them a dividend yield of 4.78%. And if we then continue to my favorites tab, namely the dividends tab, then we can see that I have received very close to $200 in dividend in total for this month, meaning that I have received a little more than $130 within this week, and that was from Exxon, Prudential Financial, Organon, and Beatrice. So this actually means for the first time ever I have received more than $1,000 in dividend income within a single quarter, and not only $1,000, actually $1,100. So that means if we go to my goals tab, then I have now reached level 30, and I have in fact also reached level 32, since that is $1,000 and $1,100 in quarterly dividends. So I'm really happy to be able to sign off these two goals as well. If we then go back to the dividend sheet here and then scroll to the right, then you can also see with the latest purchase of VICI Properties, now my estimated yearly income has surpassed $5,000. And you can see with the latest dividends that I have received that my year to date is more than 2,900, meaning that the obvious next goal will be to reach goal number 25, since that is 3,000 in yearly income, and I expect to receive that sometime within October. Another thing that significantly affects the dividends which I am receiving are that the companies are raising their dividends hopefully every single year. So an email like this from Verizon in the beginning of September, where they have announced that they will increase their dividend by 2%, and this week, for instance, where Store Capital announced that they're going to increase their dividend by 7%, that really helps me out a lot as well. If we then turn to my latest purchase of VICI Properties. So first of all, we start by going into their webpage in the About section, I will of course include a link in the description below for this webpage. So VICI Properties is one of the country's largest owners of gaming, hospitality and entertainment destinations. This is of course in the United States. So if we scroll down a little further, we can see that they have 28 leading gaming facilities and more than 47 plus million square feet owned, more than 200 restaurants and more than 17,800 wholesale rooms and 4 golf courses. So their most significant property is without a doubt the Caesars Palace in Las Vegas, Nevada. So just with this very brief glance at their webpage, we now know that VICI Properties is an experiential real estate investment trust. So now that we just have a very brief understanding of what VICI Property is, let's see how they fit the guidelines. So if we go to Seeking Alpha and look up VICI, then we go to dividends and the dividend scorecard, then we can see here that the dividend yield is 4.87%. Just as a quick reminder, the dividend yield which I'm receiving is 4.78% because I paid a little higher price than what they're currently trading at. The next thing we check is the dividend yield here, seeing that the 4-year historical average is 3.95, and since I'm getting a higher yield, that indicates that perhaps now is not the worst time to buy, at least not if you're looking over the last 4 years. Unfortunately, you can't really use guideline number 3, saying that the PE ratio should be in line with its peers, since PE ratio makes no sense when you're talking about a real estate investment trust. So if we go back to the summary here, what I note is that the price divided by funds from operations is below 15. Here I would simply just use my common sense from the intelligent investor in saying you should never pay more than 18 in PE ratio, or that would be the equivalent of having a price to funds from operations above 18, and ideally you want to buy below 15. So here I note that I'm just slightly below 15, so I would say that is sufficient for me to fulfilling rule number 3. If we then move on to guideline number 4, having a payout ratio of below 75%, once again, this is a real estate investment trust, so their payout ratio might be quite high due to the fact that they are required to have a very high payout ratio in order to get the tax benefits from being a real estate investment trust. So here I just note that it is below 75%, and then I continue and say that's a pass as well. If we then continue with guideline number 5, diversity across sectors, well, we can now see that the real estate piece of my pie takes up a little more than 22%, but what I have to note here is that there's a big difference between VICI, even though that's a real estate, and Store Capital, since they are actually in quite different markets, since VICI is this experiential REITs, where Store Capital is this mid-market REIT. So even within the 22%, I will say that now I have actually diversified quite a lot there as well. So I will easily give that a pass as diversifying across sectors. If we then continue to guideline number 6, a good dividend history, well, if we go to the dividend history tab here, then we can see that VICI has increased the dividend for 3 consecutive years, and since the company has only existed for 3 years, well, then it's really hard to beat that as a dividend growth history. But what I find truly remarkable is that even in 2020, during the global pandemic, they managed to increase their dividend by 10%, where most of other REITs halted their dividend, or some of them even had to cut their dividend. They actually still managed to increase it by 10%. So this truly speaks to the well-being of this company, and also that they were capable of collecting 100% of the rents from their tenants. And then we arrive at guideline number 7, which is, as always, the hardest one to determine, since strong company potential and a good moat. Well, a good moat in this sense would mean that you have the right properties, that you are at the right location. And I mean, Caesars Palace on the Las Vegas Strip, you can't get a much better location than that. And At the same time, they're trying to buy the Venetian, which is also located at the Las Vegas Strip. So really doubling down on the strategy which is working. So you can say if it works, it really works wonders for them. But at the same time, you could say perhaps this is too narrow of a focus if you want to be harsh in that sense. So that is really up to you. That is perhaps the drawback here, that this REIT is so much focused on experiences. So if you don't believe that there will be a need for these experiences, then this is definitely not an investment for you. But personally, I believe that people are so hungry to get out and get experiences after the lockdown that we have seen in almost any countries. And even if people from outside the States don't travel to the States, I believe that internally there will be so much demand from the population that they will have a quite prosperous future ahead of them. And while we're talking about having a strong company potential, well, what is more natural than to look at what the insiders are doing? So if we look at Open Insiders, just to see what the insiders are doing in VICI, we can clearly see here that both the CFO, the CEO, and the COO has been buying, and one director as well. And I mean, they have been buying at around $25, and one director has actually been buying all the way up to $28. So when I'm paying a little more than $30, then hopefully that is not too high of a price for me to actually make a substantial profit as well. Another way to view the price is of course trying to see what the analysts are saying. So if we go back to Seeking Alpha, then you can go check rating, Wall Street analyst ratings, and then you can see that there are 13 analysts which are very bullish, 2 who are bullish, and 1 who is neutral, and that they have a price target of $36.75. So that means when I'm buying at around $30, that I should have a margin of safety of around 20%, if you believe that the analysts are correct. So even here it still makes sense for me to buy, since I believe that I can currently buy the share at an attractive valuation. So that actually sums it up for yet another exciting week of the Lazy Money Game. So hopefully now, once again, my strategy has become even more clear, and why it is not just high dividend paying companies which I am investing in to begin with, why I focus more on companies which I believe can grow their dividend in the future. Then you saw an update to my portfolio where I was really happy to announce that I have now achieved 2 further goals, namely 1,000 and 1,100 in quarterly dividend income. You can see some of my thoughts regarding VICI Properties and why I have decided to include them in my portfolio, since I believe that currently I can buy them at an attractive valuation and they fit really well into my portfolio. Unfortunately, I don't believe that I will make an episode next Sunday, since I will have quite a busy week. So until I see you next time, bye!